Welcome back to REIQA.com Real Estate Education Program. Be sure you started with the welcome video and have already completed sections 1 through 9. In section 10, we will cover how to use seller financing as an exit strategy, or how to be the bank. Please subscribe to our channel, like this video, and ask any follow-up questions in the group. Our experienced investors will respond throughout their days to help you. Check out our website at REIQA.com and the links in the description below for more real estate help, tools, and resources. Now, let's begin section 10. As for my experience, using seller financing as an exit strategy, or doing what the banks do, is one of my favorite exit strategies. So, what does a bank do? A bank or lending institution holds clients' money, paying them a very minimal interest rate of up to 2%. Then turns around and loans their clients' money back to them or to other clients, and charges higher interest rates like 4 to 8% for mortgages or 10 to 30% on credit cards. The bank doesn't have a mysterious bucket of money to pay their clients. They're paying them by loaning out their clients' money for a profit and in return paying them a small cut for keeping their money in the bank. So, let's say you have $100,000 in the bank, drawing a generous 2% interest with today's rates. The bank loans it to another customer to purchase a home and will charge him 6.5% interest. So, they're making 4.5% off your money. What if you could eliminate the middleman and loan the money direct to a client and have your money be backed by first lien on the property, just like the bank would do? This is the concept of seller financing instead of being a landlord. Families willing to pay X amount for rent would much rather pay that same amount or even a little more to buy a home. So, why not sell them the property on terms and eliminate all the landlord headaches? They're responsible for all repairs, taxes, insurance, etc. If you cash flow $500 per month, that's your cash flow, not the heat and air guy's money or the roofer's money or the plumber's money. You don't have to ever wonder what your cash flow will end up being. You need to understand, the seller finance value is not the same as the A.R.V, comparable sales, or appraised value. To truly grasp the concept behind being in the seller finance business, you must understand that there is another value placed on properties, known as the seller finance value. The SFV has nothing to do with the A.R.V, sales comps, or appraised value. It's totally based on rental rates for comps. If your property would rent for X amount per month, then that number or even slightly higher is what the monthly payment should be if you sold the home with seller financing provided. But you can charge that monthly payment for any number of years, 10, 15, 20, or even 30. Remember, the buyer would prefer to eventually own the property versus paying the same amount in rent over the same amount of time and still owning nothing. So, if you take the monthly payment they can afford and run it through a home affordability calculator with the down payment, insurance, taxes, your interest rate, etc., you will get the total home price or seller finance value. There are laws in place for consumer protection that you will need to educate yourself on and follow if seller financing to owner-occupants. Mainly, the Dodd-Frank seller financing laws. Research Dodd-Frank to learn more about the limitations and laws prior to entering into any seller finance contracts. This does not apply if seller financing to other investors who are not going to live in the property, only to owner-occupant buyers. There are also state usury interest laws limiting the interest rate you can charge based on the state the property is located. There's less laws when selling on terms to an investor or when you buy on terms as an investor. With a rental property, the owner or landlord is responsible for the repairs, insurance, taxes, etc. With seller financing, the tenant buyer is the homeowner and is responsible for all repairs, insurance, taxes, etc. Let's look at some examples of deals. So, let's use the numbers on a deal I did back when I was first getting started doing seller financing as an exit strategy. It was a cheap property that was purchased for $30,000, but was livable and worth around $50,000. Let's look at what would happen if you rented it versus seller financed it as your exit strategy. First, as a rental property. The purchase price is $30,000. The closing costs around $2,000, insurance $75. You do cosmetic repairs for $2,500 and an extra $100 for advertising to get it rented. That brings your total invested to $34,675. Let's say the rents are $600 a month or $7,200 per year. Minus $900 a year for insurance, $900 for taxes, 10% for repairs, and 10% for property management. So, your annualized net profit would be $3,960, or 11.4% cash on cash ROI. Now, let's look at the same property using seller financing as the exit strategy. The purchase price is the same $30,000. The closing costs around $2,000, insurance is still $75, and an extra $100 for advertising to get it sold. But you have no repair costs because you sell it as is, offering to seller finance it. That brings your total invested to $32,175. Let's say you sold it as is to an owner-occupant for $55,000 and collect a down payment for $5,000, and you carry the note 10 years at 10% interest. Their monthly payment would be $660, and they're responsible for the insurance, taxes, and all repairs. So, your net cash invested would be just over $27,000 because you collected the $5,000 down payment. The total note carried over 10 years would generate just over $52,000. Annualized, that's a little over $5,000 per year, or 19.2% cash on cash ROI. It's actually more upfront because it's front-loaded based on amortization schedule, and you receive more interest in year one, and it goes down over time. This also makes your note value stay higher if you ever wanted to sell your note after seasoning for 6 months or longer, because it's based on remaining principal value. We'll cover selling notes in a later video. Every month, the profit is your profit. No ongoing reserves required. Your clients are now homeowners instead of renters, so they will fix up the property and maintain it well. If you ever had to take the property back, you will usually get it back in better condition. And if they decided to refinance and pay it off early, you end up making an even better return because it's mainly interest at first. I've sold around 100 seller finance deals just like this, and only ever had to take one property back after the buyers fell behind a couple months. Most of the buyers paid very well, on time, and only a few ever got behind. That cash flow comes in every month without having to hold back any reserves worried about repairs and zero calls about clogged toilets. Home buyers don't call the bank when something needs fixed. You fix it yourself or hire someone to do it. It works the exact same way when you become the bank instead of a landlord. Now, let's look at the same property, but using a private money lender for the acquisitions instead of your own cash being tied up. The purchase price is the same $30,000. The closing costs around $2,000, but you also add in an extra $2,000 fee to yourself to help cover your marketing overhead. So, you borrow a total of $34,000 from your private lender. And let's say they're happy with 8% interest and amortized over 10 years. We'll use the exact same numbers as the previous example. So you sold it as is to an owner-occupant for $55,000 and collect a down payment for $5,000, and you carry the note 10 years at 10% interest. Their monthly payment would be $660, and they're responsible for the insurance, taxes, and all repairs. So, your net cash invested would be just over $27,000 because you collected the $5,000 down payment. The total note carried over 10 years would generate just over $52,000. Annualized, that's a little over $5,000 per year, or 19.2% cash on cash ROI. So, you would still receive monthly payments from your buyer for $660. And your payments to your private lender are $412. That means your monthly clear cash flow would be $248, or annualized cash flow of just under $3,000. Over the 10 years, that's just under $30,000 you make in cash flow. But wait, remember you get paid 3 times. You made $7,000 up front at closing, $5,000 from your buyer's down payment, plus $2,000 extra you borrowed to help with marketing. Add on your $30,000 in cash flow over 10 years. That brings your total profit to almost $37,000. And remember, you didn't invest one penny of your own money. Infinite returns, just like the bank, just by having the knowledge, finding the deals, and connecting the dots. If you want to make an even better return, or when doing more expensive properties, carry them over 20 years or 30 years, and the numbers are very high returns because it's almost all interest at first. And you may be asking, but what if they refinance with a bank? I lose all those years of cash flow. You actually end up making an even higher ROI and can roll right back into another deal. There's no better phone call than calling your private lender and telling them you're going to pay off their note, and then telling them about another deal you have if they're interested. Of course, they will be. That concludes this section. In the next section, we will discuss note buying and selling. Yes, you can sell your notes to cash out early if you ever need to. Please subscribe to our channel, like the video, and ask any follow-up questions in the group. Our experienced investors will respond throughout their days to help you. Check out our website at REIQA.com and the links in the description below for more real estate help, tools, and resources.